obviously with the events of yesterday and Biden being inaugurated and those key executive actions, we are seeing definite clear direction now in the policy moving forward. And following up on the fiscal comments last week from Janet Yellen, that the market is now pricing in a coordinated monetary and fiscal stimulus moving forward, and that's helping asset prices, particularly yesterday.
In a negative, because it was noted yesterday that investors were not focusing on some of the downside, whether it's tax and regulation eventually. Also, of course, the rollout of vaccines that has been a little bit stop-start in many parts of the world. You've pointed out the policy misstep risk is high because of COVID-19. Just walk us through that downside scenario and how you protect the portfolio at this stage.
Yes, so obviously the key risk is the effectiveness of the vaccine moving forward against these new variants that are popping up. So key defensive positioning could still be a form of fixed interest, maybe more in the corporate bond space or a good quality credit there. There is still a little bit you can have in the fixed income space, but we would prefer to have more spread risk than duration risk at this point.
Let's just focus for a moment on valuation, Scott. Does it matter when we look at the headline US indices at this point? Because I think on traditional price earnings metrics, we're a long way away from long-term averages.
Yes. So when you look at the CAPE, we're very much at all-time highs moving forward. Now, the case in point you could make there is this versus 2000. The earnings are far more international and diversified than they were back then, and you don't necessarily have all the junk names that we had in 2000 as well. So yes, valuations are a little eye-watering, but they still have room to go higher in the current environment and the current support being provided to markets.
The catalyst then for reversion to the mean, or have we now abolished reversion to the mean as an investment concept?
The reversion to the mean will, if we do see it, it will be in the latter half of the year when we see the rate of change of economic growth slowing from the very good numbers that we will see in Q2. So that's really what we watch out for is in the second half of the year is how do the policies both implemented in the United States and in Europe impact economies for the second half of the year. Now, given the coordinated aspect of the United States, we do expect the US to be better than Europe, but also we look towards Asia as a more ideal place for investors to have risk at the moment overall.